Hello children, the lesson we will be learning today is Chapter 10, Marginal Costing and Absorption Costing. Now take out the student book 2 and turn to page 181. This lesson is mentioned in the IAL Accounting Specification 2.8.1 to 2.8.6. The learning objectives of this lesson will be to understand the concepts of marginal costing and absorption costing, evaluate the advantages and disadvantages of marginal costing and absorption costing, calculate the value of inventory using marginal costing and absorption costing, use marginal costing in decision making, prepare profit or loss statements using marginal costing and absorption costing, decide on a preferred course of action when there are limited factors. Suppose a business produces 100 products and the costs are £100 for variable and £100 for fixed. Now what is the total cost per unit of production? 100 plus 100 divided by 100 will give you £2 per unit. If the business produces one more unit, will that cost £2 for the business to manufacture? How can we decide the cost for the extra unit? Should this include all the production costs or only the additional cost of making the extra unit of production? In costing, we measure the cost of all inputs and compare them with the value of the output of the business. There are two methods that are commonly used: absorption costing, also known as full costing, marginal costing. The difference between the two is the way in which overheads are treated. In absorption costing, the overheads, both fixed and variable, are included in the cost of production and the value of inventory. In marginal costing, only the variable overheads are included in inventory. The fixed overheads are all written off against production in the year of production and not incorporated into closing inventory. The overheads are considered to relate more to time than to the volume of production and therefore are written off in the year incurred. Absorption costing. In determining the unit cost, all direct and indirect production costs, whether variable or fixed, are included. If a business wants to set prices for its output in order to make a profit, the prices charged must cover all costs. Under this method, the full cost of production is absorbed into the unit cost. Overheads are apportioned to the product cost. In the case of variable overheads, they are directly traceable to the product, while with fixed overheads, they need to be apportioned to the product. This can be expressed as total product cost equals direct cost plus share of overheads. Now we will discuss the advantages of the absorption costing approach. Through absorption costing, all production costs are considered to match against the income earned. Cost plus pricing is an approach used to set price. If a company uses cost plus pricing, the absorption costing would be the most appropriate method to calculate the cost. According to IAS 2, the accounting standard for inventories, absorption costing is the acceptable method to value the inventory of the company. In addition, the absorption costing is accepted by the accruals concept. As mentioned in the first advantage, the accruals concept states that all the revenues earned during a particular period should be matched against the cost incurred during the same period. Now it's the time to look into the disadvantages of absorption costing. There will be an issue with the cost estimation or apportion. If it is inaccurately estimated, the effect on the decisions will be negative. The overheads might be over or under absorbed due to the incorrect apportioning. The information required for the costing will consume time in collection and difficult to be collected also. Now let us see how an example is worked out. Mr. Lamb placed an order for 65,000 units of rugs. The producer needed to give a price to Mr. Lamb for the order, and so it had to do some cost calculations. Material consisted of 12,400 meters at 6 pounds per meter. Labor required to manufacture the units would be 5,000 hours at 20 pounds per hour. Additional material for packing would cost 12,800 pounds. Factory indirect costs would have to be allowed for 500 hours at 30 pounds per hour. With this information, prepare a costing sheet for the producer so that Mr. Lamb can be given a price for the order. What would the price be if selling and distribution costs of 6,800 pounds had to be covered and the usual markup is 10%? Can you see how the cost sheet is prepared to find the total cost using the given information? It is 112,200. So using the absorption costing, we use the formula direct cost plus overheads plus profit equals to the selling price. The total cost is 112,200 pounds, to which selling and distribution costs of 6,800 will be added. This gives a total of 119,000 pounds. Adding a markup of 10% will give you the selling price of 130,900. Marginal costing. In marginal costing, only variable or marginal costs are considered in determining the cost of a product. Marginal costs are the costs involved in the production of an extra unit of output. Although they exist, fixed costs are irrelevant for decision making in any marginal cost calculation, as all decisions are based on the contribution calculation. Marginal costing asks how much it costs to produce one more unit, and the only additional costs are variable costs. Before examining marginal costing in detail, we need to understand what is meant by the term contribution. Contribution is an important concept in management accounting. It is defined as the difference between the selling price and the variable cost per unit. The contribution is the amount contributed towards the fixed costs of a business and to its ultimate profit. The profit will be brought about when the fixed costs are covered and there is a surplus. Once we have calculated the amount of the contribution, we then deduct the fixed costs from the total contribution to arrive at a profit or loss. Therefore, the full equations are total contribution equals to sales revenue minus total variable costs, profit or loss equals to total contribution minus fixed costs. Let us see how marginal costing benefits the companies. The companies would not need to face difficulties in apportioning fixed cost to production now. If absorption costing had been used, the inventory will be valued using fixed costs as well. Marginal costing would not absorb the fixed costs in the closing inventory, which would not overstate the profits. Marginal costing is mostly used for short-term decision making, as the fixed costs are being avoided in costing. Prudence concept states not to overstate profits and assets. If the second benefit is considered, absorption costing is against the prudence concept, despite marginal costing is accepted by the prudence concept. These are the disadvantages of following the marginal costing approach. According to the prudence concept, losses can't be estimated. In this context, using marginal costing would be identifying losses in the current financial period which will actually be able to manufacture in another period. If a company has an automated production, this marginal costing would not be appropriate, as there are more of fixed costs with lesser variable costs. In a situation of low demand, the marginal costing would enable to lower the prices. This might misunderstand the customers who will expect low prices all the time. Under marginal costing, the total variable cost would vary, but in absorption costing, the cost would be consistent due to the fixed costs. This will result in consistent profits using absorption costing. According to IAS 2 inventories, the marginal costing is not accepted, This is because the total cost of production is not considered when valuing the inventories. Marginal costing is appropriate for short-term decision making, not for long-term decision making. This is because all the costs need to be considered for long-term decision making. A significant difference between the two costing methods is how inventory is valued. Marginal costing values inventory at the total variable cost of production. Direct material, direct labor, direct expenses, and variable production overheads. It excludes fixed costs. Absorption costing values inventory at the full production cost. It includes both variable and fixed costs. Inventory valued using absorption costing will have a higher value than if valued using marginal costing. Since the latter excludes the fixed cost element of cost, this will affect the profit for the year in the statement of profit or loss and other comprehensive income. In this example, you will learn how to value the inventory using both the methods. A business has the following costs for one of its products. Direct materials 20 pounds, direct labor 11 pounds, direct expenses 1 pound, variable production overheads 5 pounds, fixed production overhead 12 pounds. What are the inventory valuations using the two methods? The cost per unit using marginal costing is found by adding all the variable costs, which is 37 pounds. Absorption costing includes the fixed overhead share on the production. This will add up to 49 pounds, which is higher than the cost per unit of marginal costing. In order to best use costing information, a business must compare the various proposals made to it by its customers. We will see that the determination of profit or loss is irrelevant in marginal costing. However, what is relevant is if there is a positive contribution. If there is a negative contribution, the proposal must be rejected. This section examines a number of different decisions a business might need to take. In all cases, some form of costing is required to help in making the decision. For example, should it accept or refuse new orders? Should it make or buy a product or component? Should it stop the production of an item or close down a section of the business? If it is limited by shortages of space, machine hours, materials, labor or other things related to the business, what action should it take? Usually, a business receives special orders from customers at a price lower than normal. In such cases, the business will not accept the special order if it can sell at its output at normal price. However, when sales are low or when there is idle production capacity, special orders should be accepted if the incremental revenue from special order is greater than incremental costs. This method of pricing special orders, in which price is set below normal price but the sale still generates some contribution per unit, is called contribution approach to special order pricing. The idea is that it is better to receive something above variable costs than receiving nothing at all. For many businesses, especially in manufacturing, orders for their products are negotiated with the customer, and the selling prices are often different between customers. A business must be able to work out whether it would be profitable to accept an order that has a different price from the normal price charged. It is not as simple as just refusing an order if the selling price is below the standard price. Using the contribution formula, selling price minus variable cost, if the order results in a positive contribution, the order should be accepted in the short term. The contribution will increase the profit. If the contribution is negative, the order should be rejected as it will decrease profit. In general, an order at below the normal selling price should only be accepted in the short term and when there is spare capacity within the business and it would not result in the refusal of orders at the normal price. The customer is made aware that this is a special one-off price and might not be available in the future. and existing customers are not made aware of this, as they might demand a reduction in price, and neither does the customer enjoying the special price sell the goods on to its own customers at a lower price than the standard price. What would happen if a customer offered to purchase 10,000 party bags at a price of £22 per unit? The selling price is currently £36 at a current output of 20,000 bags. You are provided with all the necessary costs with the required profit, which has added up to the selling price per unit. The way in which we present our figures is important. We see that the layout in the first case, where the fixed costs are allocated to each unit, is not particularly helpful. Therefore, the contribution approach will give us a far clearer view of the situation. As you can see, all the fixed costs are being removed from the calculation. Note that in this example, although the company would lose revenue of £140,000 on an output of 10,000 party bags, the additional contribution to the profit of the business would be £120,000. This is because the fixed cost would be incurred whether or not the order was accepted. Therefore, we can conclude that if the selling price per unit is £22 greater than the variable cost per unit, then production should continue in the short term. Make or buy decisions. A business may be able to purchase a component that it normally makes itself. Therefore, the business needs to be able to calculate whether it should make or buy the component. To do this, it should examine the marginal costs and revenues. When comparing the company's variable cost along with the external price, the company may purchase the unit from outside rather than manufacturing it within the company, only if the company's variable cost is higher than the external price. Situation being the opposite, the decision would change. The company would decide to manufacture the unit within the business, avoiding purchasing externally. Now let us see how the make or buy decision is made. RTN company is considering whether to purchase a component from an outside supplier or produce the component itself. The estimated costs to the company of producing the component are as follows. Variable costs £450, fixed overheads £100, total £550. The outside supplier has quoted a figure of £500 for supplying the component. How would you advise the company? The variable costs are £450 and the buy-in price is £500. If RTN company buys in the product, its cost would be £500 plus its fixed overheads of £100. Assume that the fixed cost will remain at £100 and that these costs will have to be absorbed either by this product or another. This makes a total of £600. Therefore, the decision must be for RTN company to manufacture the product itself, as there is a positive contribution of £50, manufactured cost being £50 less than the buy-in cost towards fixed costs. However, there are other considerations if RTN company decides to buy from outside, such as the qualitative factors, that is, factors not expressed as numbers, and the opportunity cost. These considerations might include the effect on competition, the effect on staffing, whether quality may be affected, how suppliers are affected, whether the customer is dependent on the product, future orders from customers, the continuation or discontinuation of a service or manufacture of a product. When a business is deciding whether it should stop supplying a product or service, it is effectively deciding whether a department should be closed. Again, it is the marginal costs that are considered when making the decision. Okay, for better understanding, we will see how to make this decision for the example provided. A large retailer is considering the closure of one of its departments as it is making a loss. The profit statement of the department in question reads as follows. Can you see there is a net loss? What should the retailer do? Use marginal costing to calculate the contribution. Remove the fixed overheads 180,000. There is a positive contribution of 140,000 pounds. If the department closes, the retailer will be worse off by 140,000 pounds. This is because the fixed overheads are unavoidable and therefore irrelevant in the decision. If the decision is based purely on numbers, then it may be to keep the department open. Limiting factors. It is not only demand in the marketplace that limits the amount produced but also the availability or lack of resources such as skilled labor, raw materials, time available on certain machinery, and working or storage space. What happens when there is a shortage of such resources? Under these circumstances, the answer cannot be based simply on a positive contribution. Rather, a ranking system is required based on the usage of the scarce factor so that the contribution is maximized. The method used is to isolate the scarce resource and recalculate the contribution per unit of the scarce factor. The most profitable combination of products will be when the contribution per unit of the scarce factor is maximized. Now we will look at a more comprehensive worked example of a limiting factor as given in the slide. A business produces three types of products A, B and C. The revenue per unit and cost per unit details are given. Owing to material shortage, the firm will only receive 80% of the materials requirement for September 2019. Prepare a statement to show the maximum profit for the 3 months ending 30th September 2019. This is a step-by-step process, so we will learn each step. Step 1. Calculate the amount of resources available. Multiplying the number of units sold for each product with the direct material. After getting the total requirement of the direct material, if we multiply the available requirement due to the shortage, we will get the amount of resource available. Step 2. Calculate the unit contribution for each product. Using the given information, it is very easy to find the unit contribution, that is, selling price minus variable costs. Step 3. Calculate the contribution per limiting factor. Use the contribution calculated in step 2 to calculate the contribution per limiting factor. In this case, materials using contribution per unit divided by cost of limiting factor per unit can be used. This calculation is done for each product and reveals which product provides the highest contribution for every 1 pound of cost of limited resource paid. So here product A 0.5 pounds, product B 0.6 pounds and product C 0.625 pounds. Step 4 is to rank the products. Based on the results shown in step 3, rank the contribution per limiting factor from 1, the highest result, to 3, the lowest result. So, as you can see, product C is ranked as number 1, product B is the second one and product A is the third one. Materials will first be allocated to product C. If there are still materials available, they will be allocated to product B fully. If there are still materials left after allocating to product B, the remainder will be allocated to product A. Step 5. Resource allocation to each product based on the rank. Here we have a material cost available of 26,400 pounds. So as product C has the first rank, we have to allocate the resources for product C first. 2,500 units into 8 pounds will give 20,000 material cost allocated for product C. So when we deduct 20,000 from 26,400, 6,400 will be left over for the other products. Since this is not enough to fulfill the product B completely, we have to find how many units of product B will be produced based on 6,400 pounds material cost. To find this, we have to divide 6,400 pounds by the £10 material per unit cost of product B. Then we will be able to calculate the number of units, that is 640 units. Then firm will be producing 2500 units of product C and 640 units of product B. No product A will be produced since there is not enough material available to cover product B also. So there will be no material at all for product A. Here we will be looking at the differences between the two methods in the pricing of a product and the reported profit or loss for the year. Since the valuation of inventory will differ between marginal costing and absorption costing, the profits recorded will be different as inventory levels change. A marginal costing system will record inventory using only the variable costs, while absorption costing will include fixed costs in the valuation of inventory, which will be carried over to the next accounting period. In marginal costing, fixed overhead costs are not included in the cost of sales and are treated as period costs, written off as an expense in the period they are incurred. In absorption costing, on the other hand, fixed overhead costs are absorbed in the cost of the units of production and so are included in the cost of sales. When inventory levels increase, then with absorption costing, the recorded profit will be higher than with marginal costing as more cost is carried over to the next financial period. Where inventory levels decrease, absorption costing will record lower profit than under marginal costing. If inventory remains unchanged and unit costs are the same, there will be no difference in the level of profit recorded. In the long term, the profits of the business will be the same under both costing systems. So now we are at the end of the lesson. Thank you for watching the video. Stay safe, children.